The electric car was sold as an economic engine and a climate fix jobs, growth, and cleaner air. Capital chased the story. Subsidies multiplied. Headlines declared a revolution. In 2021, Tesla's valuation crossed the $1 trillion line and eclipsed the combined worth of legacy giants. Public money for EV incentives nearly doubled that year. Global sales leapt from fringe to mainstream. The global push for electric cars has promised a cleaner future. Governments set bold targets. For example, the EU decreed that from 2035, all new cars cannot emit any CO2. Sales of EVs have surged as a result, yet experts are now spotting problems beneath the surface. Making EV batteries is very carbon intensive. One study found 46% of an EV's lifetime emissions come from its production, and building a single EV emits roughly 4 tons of CO2. Mining lithium and cobalt for batteries also consumes huge amounts of water and pollutes local ecosystems. In short, the green car is not entirely clean. But a decade of exuberance is meeting hard constraints. Battery metals spiked, then crashed. Startup darlings imploded. Governments that primed the market now confront overcapacity, price wars, and trade friction. The green gold rush has begun to look like a bubble, one that could backfire financially and geopolitically if we don't steady the landing. Cheap money and aggressive policy made EVs the next big trade. When rates were near zero, investors funded anything with a plug. In 2020 to 2021, blank check deals took pre-revenue EV and charging firms public at eye-watering valuations. For a moment, the market priced promise over physics. Building cars at scale is brutally hard. Margins are thin, supply chains are complex, and manufacturing hiccups compound. The shakeout came fast. Flagship SPAC names saw share prices collapse by 90+%. A number filed for bankruptcy within a couple years of ringing the bell. Even for established players, expectations outran fundamentals. Hype, not unit economics, set the price. Governments amplified the cycle. Incentives lifted demand and de-risked supply. That worked up to a point, but blunt stimulus can spawn misallocation. Nowhere is that clearer than the world's largest EV market. China is the EV superpower, the biggest market, deepest supply chain, cheapest scale. Local and national subsidies, cheap credit, and industrial planning pulled hundreds of entrants into the space. The payoff: world-leading makers of batteries and cars, low sticker prices, and massive exports. But scale cut both ways. When dozens of brands chase the same customer, prices raced to the bottom. A ferocious price war crushed margins. Revenue growth lagged unit growth. Officials began preaching self-discipline, signaling consolidation. Analysts now expect only a sliver of today's brands to survive. The lesson for the world: subsidies can birth an industry and also saturate it. Bubbles don't just inflate inequities, they form in commodities feeding the dream. Lithium, the white gold of the battery age, went vertical in 2021 to 2022 on shortage fears. Then supply surged, demand disappointed at the margin, and prices cratered more than 80% from the peak. Nickel delivered its own drama, spiking to 6 figures per ton in days before trading was halted. These are not normal moves. They are the signature of a market built on extrapolation. As prices rolled over, marginal mines paused, projects were shelved, and whole business plans unraveled. Communities that geared up for a decade-long boom now face layoffs and idled assets. The cycle is textbook. High prices invite supply, supply kills price, the latecomer bleeds. And yet, extraction isn't the only path. As Elon Musk put it, a dead battery is essentially super high-grade ore. If the economics of recycling scale, the industry can shift from digging new holes to harvesting old cells, reducing vulnerability to booms and busts. But that circular promise still has to meet industrial reality. The commercial math of EVs is improving, but for many automakers, it's still unforgiving. Consumers love the talk, hate the price. Incentives bridge that gap. When they fade, demand softens. In some markets, subsidy cuts showed up almost immediately in sales data. Inventories swelled, discounts followed, and margins compressed. Battery costs did fall over the past decade, then flattened and even ticked up in some years as input volatility and financing costs bit. Meanwhile, charging infrastructure remains uneven. The result is a transition that's real, but lumpy. Investors are relearning a simple rule: technology curves don't repeal business cycles. Meanwhile, a new strategic issue has emerged. Chinese automakers have stormed into Europe on the wave of the EV boom. BYD, the world's largest EV maker, is now building a factory in Hungary to produce cars for the European market. It even plans a second plant in Turkey. starting in 2026. As a result, BYD's sales in the EU have exploded. In September 2025, it sold 3 times as many cars as a year earlier, surpassing Tesla for the second straight month. The EV era doesn't end resource geopolitics, it rewires it. Where oil pipelines once defined power, refinery maps for lithium, nickel, and cobalt do today. China spent a decade building dominance across the battery value chain, processing the majority of key minerals, and exporting a tidal wave of affordable EVs. Decades ago, the G7 nations, the United States, Europe, Japan, and Canada, held the reins of world trade. Today, their grip has slipped. Together, they command barely 28% of global GDP in P terms, down from roughly half in the late 20th century. China's economy, by contrast, has surged to nearly 1/5 of world output. In a world drowning in debt, over 235% of GDP, and reeling from stagnating growth, this shift has left many leaders on edge. As new money trails emerge, old alliances strain. Analysts note that the defining force now is the deepening US-China rivalry. Economic policy is increasingly seen through a geopolitical lens. Trade and technology are treated like arms of statecraft. Global growth is only modest. The IMF projects roughly 3.3% in 2025, with inflation easing to about 4%. But confidence is fragile in this climate of distrust and strategic maneuvering. That dominance delivers leverage. When low-priced Chinese EVs landed in Europe, policymakers accused Beijing of distorting competition with state support and launched an anti-subsidy probe. Brussels pointed to price gaps of roughly 1/5 versus local models. Tariffs are on the table. Green trade politics has arrived. Supply concentration is more than a trade gripe. It's a vulnerability. Cobalt is the starkest case. Most of the world's supply is mined in the Democratic Republic of Congo, and Chinese firms control a commanding share of that output and downstream refining. Any disruption, political, environmental, or economic, ripples through global battery supply. Across the Channel, Britain is trying to shore up its transition. In July 2025, the government launched a £650 million grant scheme to make electric cars cheaper. Buyers of fully electric models under £37,000 can now get up to £3,750 off at the point of sale. The program revives subsidies that were cut in 2022, after ministers saw warning signs of slowing demand and falling resale values for used EVs. By targeting mid-range models, officials hope to move the technology beyond early adopters and into the mass market. Supporters see it as a bridge policy to keep sales climbing until EVs reach true price parity. Critics argue it risks propping up short-term demand rather than solving long-term challenges like charging infrastructure and battery costs. Either way, it signals the UK is willing to spend heavily to keep its 2035 phase-out target alive. Conflicts sharpen these edges. The war in Ukraine upended energy flows and rattled metal markets, with nickel's shock surge a case in point. Less discussed is Ukraine's own endowment of critical minerals. Control of lithium-bearing ground, or the interruption of future projects matters to a Europe seeking domestic supply. In parallel, resource nationalism is spreading. Chile moved to tighten control over lithium. Mexico nationalized its reserves. Others sought to move up the value chain. The logic is clear: capture more value at home, even if it slows investment or complicates cross-border supply. Meanwhile, the US, EU, Japan, and partners are friend-shoring critical minerals, tying incentives to local or allied content, financing mines and refineries, and trying to outrun permitting delays. It's a race to reduce single-point failure without splintering markets so badly that costs climb for everyone. Does a bubble mean the mission fails? After the dot-com crash, the internet didn't vanish, it matured. The same dynamic is likely here. A shakeout can purge weak business models, reprice assets, and force discipline. EV adoption continues to rise globally, even as the cost of capital and policy ambiguity expose overreach. The real risk isn't that EVs die, it's that confidence does among consumers, investors, and voters. If taxpayers feel they bought an illusion, support for climate policy erodes. If automakers sour on the economics, they slow rollouts. If nations treat minerals as zero-sum, the system fractures into blocks and duplication. In that world, the transition costs more, takes longer, and feeds new dependencies. A pragmatic course is possible. First, tune incentives. Shift from indiscriminate purchase grants to performance-based, sunset-dated support that rewards cost and carbon reductions declining as scale and profitability arrive. Second, diversify supply with realism. Speed permitting while tightening environmental standards. Co-invest in midstream refining and processing, not just mines. Lock in offtakes with allies, but leave room for market flexibility. Third, industrialize recycling. Treat end-of-life batteries as a strategic stockpile. Build reverse logistics, standardize pack designs, and scale plants that harvest nickel, lithium, cobalt, copper, and graphite at competitive cost. Turn volatility into feedstock. Fourth, aim for affordability. Smaller, lighter vehicles, chemistries like where fit for purpose and platform sharing can bring prices to the mass market without permanent subsidies. Finally, keep trade as open as security allows. A fragmented green economy will be slower and pricier. A rules-based system with guardrails can keep prices falling and learning curves steep. The electric car was never a silver bullet, but it is a critical tool. The bubble isn't the technology, it's the belief that money and mandates can suspend gravity. Markets overshot, minerals whipsawed, politics turned sharp. Now comes the more patient work: price discipline, supply diversity, honest accounting of costs and trade-offs. If we navigate that path, the transition stabilizes. If we don't, the backfire could be severe. Busted balance sheets, stranded assets, and a geopolitics that swaps one dependency for another. The choice is ours: manage the come down or let the bubble define the story. As one industry leader put it, a dead battery is essentially super high-grade ore. The green economy's resilience may depend on taking that sentence literally, building a system that learns, recycles, and compounds, instead of one that repeats the same boom and bust with different rocks.